Hi, I'm Elliot Gu, co-founder and chief analyst for Deep Dive Investing. Today I want to tell you about a very powerful stock market indicator that was created a long time ago. In fact, the man credited with creating it died in 1902, some 116 years ago. Yet, to this day, it still works. Look, when I tell you more about this simple market system, you might think it's just too simple to have any value. Or maybe it'll just sound too good to be true. And I certainly don't blame you for being skeptical. I always think you should check out everything you see. However, a 1998 research paper published by researchers at Yale, New York University, and the University of Miami found that in the period from 1930 to 1998, this system beat the broader stock market by 4.4% annualized. And just last night, I finished a research project examining signals from a version of this indicator since 1998. The long and short of it, this system has suggested just 7 trades since 1998, and 6 of those trades have worked. And as I'll show you here in just a minute, gains from this system since February 1998 have been 528.23%, way better than the 311.3% from buying and holding the S&P. That's because this simple indicator can help you avoid the worst of bear markets and stocks. And as I said, the best part of it all is that this indicator is just dead simple to use. In fact, as I'll explain to you in just a moment, if you have access to the internet, which you obviously do because you're watching me right now, you can start using this very old yet very powerful system for free immediately. Watch this free presentation I just created to learn more.
Hello everyone, my name is Elliot Gu and I'm co-editor and co-chief analyst of Deep Dive Investing. Today I'm going to tell you about a market timing system that's over a century old. This system first came into being in about 1902. That's the first time we really started hearing about it, so it's now over a century old. What's interesting about it though is that there was an academic paper written about this in 1998, so about 20 years ago, that examined returns from a version of this timing system over a 70-year period, and found that it beat the broader market by more than 4.4% per year. So that's pretty impressive. Now, I created a version of this system and back-tested it to February 1998. So I back-tested it basically back to where that academic study left off. And you can see the results here on your screen. The total return from the S&P 500 since February 13th, 1998 is around 311%. That's that dark blue line on your screen. This timing system, though, which is the light blue line on your screen, is up well over 530%. Sorry, 528.23%. So that's a very powerful outperformance from this. Now, what's even better about this is that the standard deviation of returns. Now, standard deviation is a measure of market volatility. And basically, we use it as a measure of risk. The higher the standard deviation, the higher the risk. The standard deviation for this system, this timing system, is actually less than the standard deviation for the S&P 500 itself. So in other words, you're getting more returns over this 20-year period than you got from the S&P 500 with less volatility. In addition, there have been just 7 trades, I should say, even though there's 7 trades over a 20-year period makes it hardly a trade. But there have been 7 positions recommended by this system since 1998, and it's been correct 6 out of 7 times. So that's more than 85% of the time. Now, of course, you can't look at past performance and say that it's going to hold up in future, but there's at least something compelling to examine here. And as I'm going to show you here in just a minute, I'm going to explain exactly what this system is, the basic theory, or I should say the basic logic behind it, and why I think it's been successful over time, and why we employ a version of the same type of data in our Deep Dive Investing bear market checklist. So let me go through this system piece by piece. First of all, you may have heard of it. It's actually called Dow theory. Dow theory. Now, it's named after Charles Dow. Charles Dow was the man who invented the Wall Street Journal. He was the first editor of the Wall Street Journal back in 1889. The first issue of the Wall Street Journal was actually in July 1889. So it's one of the oldest publications in the U.S., and I believe it's still the largest publication by circulation terms last time I looked. He also served as its first editor until his death in 1902. Now, in 1896, Dow also created, as if creating the Wall Street Journal wasn't enough, he also created the Dow Jones Industrial Average, as well as other averages that bear his name, like the Dow Jones Rail Index, which we now just call the Dow Jones Transports. Now, following his death in 1902, William Peter Hamilton became editor of the Wall Street Journal, and he claimed he learned all his ideas on market timing from Dow. Now, most of what we know about Dow theory, we actually know from William Hamilton, not Charles Dow. But because Hamilton credited Dow with the theory, we call it Dow theory and not Hamilton theory. So this theory has come to be called known as Dow theory. Now, while there's no definitive definition of what it is, which might seem kind of odd, but there's no real definition of Dow theory. But we can figure out the main tenets by reading a series of about 250 editorials written by Hamilton and published in the Wall Street Journal between 1902 and 1929. So we do have a lot of record of its use in practice. And here's the kernel of it. Dow wanted to look at two different indices. The Dow Jones Industrials, which is that black line you see on the top half of the pane of this chart, and the Dow Jones Transports, which is that orange line you see on the lower pane of this chart. And I'm using an example from 1972 to 1974 just to show you. And what he said is that moves in the Dow Jones Industrials and the Dow Jones Transports should confirm each other. So in other words, in a healthy market, when the Dow Jones Industrials breaks out to a new all-time high, the Dow Jones Rails Index, or the Dow Jones Transport Index now, should break out to an all-time high as well. And it makes sense from an economic standpoint as well, because if you think about it, the industrials make stuff, and the transports move it around to the consumers. So if America's manufacturing sector is humming, then obviously the industrial should be doing well. It should be seeing growing sales. It should be seeing growing earnings. But you should also see growth on the transport side, because those are the companies that move all those goods, industrial goods and finished goods, all around the country. So let me show you this example here from the 1970s, and some of you will remember that this is actually a period right before a very nasty bear market for stocks, partly caused by a big spike in oil prices during the first the so-called Arab oil embargoes against the United States and targeting other Western powers as well. They caused oil prices to spike. But let me show you what happened here. You can see that at the end of 1972 and into early 1973, the Dow Jones Industrials, and I'll circle it here for you, which is this top chart, broke out to a new high. So at that time, it was just over 1,000 was a new high. At the same time, though, the Dow Jones Transport Index actually had peaked out way earlier in 1972, in the first half of 1972. And when in late 1972 and early 1973, when the Dow Industrials was breaking out to a new all-time high for that time, the transports were well below their prior peak in 1972. So this is a situation where the transports did not confirm the move in the industrials. And by 1973, of course, both the industrials and the transports were breaking down. They were both breaking lower. The industrials were the leading group, but you can see, I didn't draw that line very well, but you can see that they kind of broke down from below that level where they were trading in 1972. And of course, the transports were very, very weak at this time. So that was a sign of trouble ahead. And here's a chart of the S&P 500 during that time frame. You can see here that, like the industrials, they made a new high in early 1973, January 1973, of 120.24. Sold off sharply all the way down to a low of 62.28 in 1974. That was October 1974. This was actually one of the longest and most vicious bear markets in U.S. history, rivals in many ways the Great Recession and the credit crunch that we saw back in 07 to 09. So if you'd been watching Dow Theory, you would have seen that this rally in the S&P also to a new all-time high in early 1973 was not confirmed by the transports. So that was a sign of trouble ahead. So how do we codify, what are the key points of this, and how do we codify this so we can actually test it? The first thing to keep in mind is that Dow Theory does not call tops and bottoms. It does not call tops and bottoms. It usually only registers a sell signal after the market breaks down. But I'm going to tell you why that's useful here in a second. The main reason being that strong returns over the past 20 years that I showed you earlier on are mainly due to avoiding severe downturns such as 2007 to 2009 and 1999 to 2002. Now, as I said in that first bullet point there, Dow Theory does not call tops and bottoms. It does not get you out of the market right before or at the top. It's always a lagging indicator because it's always relying upon following trends, and a trend by definition has to get established before it gets picked up by a system like this. What it does do properly is get you out of those downturns, get you out of the market for the bulk, the meat of those bear markets. And that's what's really costly. If you can just avoid the worst stages of a bear market, you will outperform the S&P 500 by avoiding the worst of the bear market and catching most of the uptrend. So that's very important. If you have a system that can just help get you out of the market even a few months into a bear market so that you avoid the worst of it, you're going to outperform. And that's exactly what Dow Theory does. Now, the method of Dow Theory that I examined over the last 20 years is dead simple. You'll be kind of shocked when you hear just how simple it is. What I said is that, and this is a similar version to what's been used in the past and what's been interpreted out of Dow Theory in the past. I looked at the Dow Jones Industrials and the Dow Jones Transports. And I looked at them on weekly data, not daily data, but weekly data. And whenever the Dow Jones Industrials and the Dow Jones Transportation Index both hit new 25-week highs, so basically a half-year high, that is a buy signal. When they both hit 25-week lows together on the same week, that is a sell signal. And the other key tenet, of course, is that once the Dow Theory issues a buy signal, you would stay in the market under that theory until it issues a sell signal, and vice versa. Once it issues a sell signal, that sell signal is in place until it issues another buy signal. There's no getting out just because you almost got a buy signal, or getting out because you almost got a sell signal, getting in because you almost got a buy signal. Both those indices have to make new 25-week highs or 25-week lows on the same week in order for this to process this signal. When this signal, and the way I looked at it was this: I'm only assuming that you're long stocks, so you're only buying the Dow. You're not shorting the Dow or shorting the S&P under the system I looked at. Instead, when it tells you to sell stocks, you just jump into U.S. government bonds. And I use the Bloomberg index of total returns from the U.S. government bond market, basically a mixture of different U.S. government bond maturities. So that it's really a switching system. When it says buy, you're in stocks. When it says sell, you are in bonds and out of the stock market. And this simple system in this way has benefited from safe haven flows. As many of you know, when the stock market starts to really break apart, fall apart, like we saw back in 2007 to 2009, everybody dumps their money into U.S. government bonds as a safe haven. So the price of government bonds skyrockets, and you can actually make a lot of money hiding in bonds while the turmoil is underway in the stock market. And during recessions, that's particularly true. Again, I have to caution that past results of this test don't necessarily mean it'll work in the future. However, the Dow Theory is basically nothing more than an analysis of market breadth. And market breadth is a key part of our bear market checklist in deep dive investing. And our 10-point bear market checklist is something that we created to help spot major turns in the stock market. In other words, to warn us ahead of time when we might be nearing the top of this bull market. Now, as many of you know, the U.S. S&P 500 is entering the 10th year of this rally. The rally started in March 2009. We're now in the 10th year. Just a few weeks from now, we're actually going to be officially the longest rally in U.S. stock market history. So it's only natural to wonder when it's going to end. It's also only natural to wonder when the U.S. economy might see its next recession. It's been a long time since June 2009 when the last recession ended. So we put in place this 10-point bear market checklist to help us figure out when it's getting very risky to be in the stock market, when we might have peaked in the stock market, when the economy might be vulnerable. And we have a list of 10 economic, fundamental, and technical indicators. Breadth is one of the key indicators. Now, to date, we haven't used Dow theory as a direct input into this 10-point bear market checklist, but I think that the results of Dow theory over the last really 100+ years show you the power of looking at market breadth. Now, the word breadth just means looking inside the market. In other words, is the S&P 500 making a new all-time high, but major groups within, major sectors and stocks within the S&P 500 are actually breaking down? That's what Dow theory tells you, and that's what an analysis of market breadth tells you. Let's look at how this Dow theory worked in the 2007 to 2009 bear market, which is the most recent bear market in stocks. And look what you can see here. If you look at the top line again is the industrials. The bottom line here, the orange line, is the transports. And I've put a vertical line there, orange on top and black on the bottom of this chart, which shows when both the week where both the industrials and the transports hit new 25-week lows. Remember, that's the little system I created to track Dow theory. And you can see that it got you out in November of 2007. Now, the stock market topped out in October, so you didn't get out at the top. However, by following this, you got out in November 2007, which was before the worst of the bear market. You were almost a year before things got really nasty in September, October of 2008. And you can see you avoided all this decline in the stock market. Here's the industrials going from up over around 14,000 all the way down to under 7,000, a more than 50% decline over this time period up to early 2009. Now, the Dow theory, when both indices broke out to new 25-week highs, it issued a buy signal. That didn't happen until actually July of 2009, so several months after the bottom in the stock market in March. So you missed out on this first part of the rally. However, it got you in for the bulk of the big rally that we've seen since. So that's how Dow theory worked in the past. What does it say today? Obvious question. Again, surprise, surprise, the industrials on top, the transports on the bottom. We saw a correction in the stock market. Both indices broke out to new highs in January, new 25-week highs, new long-time highs in January. And we saw a correction in both indices into February. And I've drawn a horizontal line at the lows in February for both the industrials and for the transports on the bottom. And what you can see here is we came very, very close to getting a Dow theory sell signal. What happened was in late March, the industrials broke down below their February lows. So that was a new 25-week low for the index. However, the transports did not break below their February low, and therefore they did not confirm that new low in the industrials. Now, a few weeks later, in April, the transports actually did very, very marginally by just a smidgen, just a fraction of a percent. In April, they closed below their February lows. However, at that point, the industrials were well back off that low, so they were no longer at a 25-week low. So these two indices did not, back in the spring, both register a new 25-week low on the same week. So we never got that Dow theory sell signal. So as I explained, what that means in Dow theory is that the prior signal is still valid. The prior signal was a buy signal issued by Dow theory in November of 2016. So that's the last signal in place, so that's the only signal that's relevant at this time. Now, fast forward until today, and I'm recording this video here in late August of 2018, and you can see that both the transport index on the bottom and the industrials index on top are breaking out and have broken out to new 25-week highs. So the Dow theory is actually now reconfirming that there's more upside for the rally. In the bear market checklist, one of the breadth indicators we use is the cumulative advanced decline line for the New York Stock Exchange. And it's saying very much the same thing. And the cumulative advanced decline line is nothing more than every single day you look at the number of stocks on the New York Stock Exchange going up in price, the number of stocks going down in price, and you calculate the difference. So how many stocks are going up versus how many stocks are going down, and then you add that number to the prior day's cumulative total. So it's a cumulative thing that keeps moving over time. And when the line's rising, it means that most stocks are basically going up. And when the line's falling, it means that most stocks are going down. Now again, think about how breadth works. If the stock market's breaking higher, that could be due to the fact that just a few large companies within the stock market that have a high weight in the S&P are breaking out to new highs, whereas most stocks aren't doing well. And that'll be registered by the New York Stock Exchange advanced decline line, because what you'll see is the stock market going up, but the advanced decline line going down. You can see that that's just not the case right now. It's not the case at the moment. We have both the stock market starting to rally, very close to breaking out to a new all-time high here in the summer. And breadth is super, super strong because the New York Stock Exchange advanced decline line is also breaking out to a new high at the time of this writing. So to make a long story short, that's Dow theory. That's how it's worked in the past. That's why it's worked in the past, I believe. And what we're seeing right now, we're seeing bullishness on Dow theory, and we're seeing bullishness in breadth. I do believe we're entering the final stages of this rally, but it's too soon to sell out of stocks just now. Thank you very much for listening to me.